Hi, everyone. This is Rob Roy, and welcome to this LA Wave Options Pro Trader Tips. In this recording, we're going to feature a strangle that we did on CNC. And strangles are something that we do in our volatility portfolio at evotrader.com. And the Pro Trader tip here is to go beyond what you just read in general. Most people know straddles. I was even taught straddles in business school. That was the only option strategy that I was taught. And when you look at a strangle, you look for one strike out of the money on the call and one strike out of the money on the put, where in a straddle, you're buying an at the money call and put. But what I discovered by just understanding and learning the Greeks, and that's the tip. If you want to trade options, learn the Greeks. And that is that there's a relationship between delta and gamma. And when you set up a strangle, you actually look for where is the best delta gamma relationship on a strangle. And that's not one strike out of the money. It's between the 25 and 30 delta on the call and put. And in this case on CNC, that was buying the 85 strike call and the 72.5 strike put. When you look at the chart, a couple of other things to look at here. One, this is a symmetrical triangle. You can do them on ascending, symmetrical, or descending triangles. And I really like having a low ADX with the triangles. Now, I want to be clear that a triangle can break out even if the ADX isn't low. But the ADX within the DMI is what measures the strength of a trend. So we are normally looking at an ADX rising if we're trading directional like we do in our AI-based impulse strategy. But in the volatility strategy, when you have a low ADX, it's telling you that you're trendless, i.e. consolidation. So one of the triangles works well. In this case, it was a beautifully formed symmetrical triangle. There's our low ADX. I like the ADX below 15 for these. And it broke out very nicely. And the exit of this trade was just 7 days later. And you can see the breakout of this triangle. Now, it's great when they break like this. They don't always do that. Sometimes they break out and just run in a 45-degree angle. Sometimes they go a little more vertical than others. But when you have a big gap down like this and a huge move to the downside, you get an IV rush into the put options. So this allowed us to close this trade out with just 7 days into the trade. Again, our AI is telling us that 21 days is the average in these. So closing out a strangle with just 7 days is shorter than normal. Our average return is between 30 and 70%. So maybe we're a little low on the profit side of things, but we'll take that when we're really low on the number of days committed to it. So 30% in 7 days on a strangle, meaning you don't have to pick direction. We'll take that every time. I hope you found this informative and look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.